If you've ever stared at a mutual fund's returns and just felt, completely overwhelmed by the sheer mountain of data, well, you are definitely in the right place. Today, we're opening up the Professional Evaluators Toolkit to see exactly how mutual fund performance is actually measured. In this explainer, we're going to break down the specific ratios, the benchmarks, and the documents that the experts use to separate the true top performers from just the rest of the pack. Okay, let's dive into our roadmap for today. First, we'll look at the ultimate measuring stick. Then we'll compare total versus price returns, match benchmarks to funds, dive into the actual math of risk, and finally wrap up by reading fund fact sheets. Let's get right into it. So imagine our mutual fund generated a 10% return last year. Is that good or bad? Well, the truth is, a standalone absolute return number like 10% actually means absolutely nothing without context. Think about it. If the overall market shot up 20% that year, suddenly your 10% return is pretty terrible, right? But if the market crashed and went down 5%, well, that exact same 10% return is literally spectacular. You see, every financial detective needs a baseline alibi to compare against. Which brings us to part one of our toolkit, the ultimate measuring stick, or establishing a baseline for performance. And that baseline, it's called a benchmark. Essentially, it's a predefined comparable against which a mutual fund scheme's performance is assessed. But here's the catch. You can't just pick any random number out of thin air. A credible benchmark has to meet some pretty strict requirements. First off, it absolutely must sync up perfectly with the scheme's investment objective, its asset allocation, and its strategy. Second, it needs to be calculated by an independent agency, like a stock exchange or credit rating agency, in a totally transparent way. Now, if you're evaluating an index fund, easy. The benchmark is just the index it tracks. But for actively managed schemes, this baseline is chosen really carefully by the asset management company to make sure investors get a fair measuring stick. So, what actually goes into calculating that benchmark? Let's move to part two, total versus price returns, and uncover the dividend difference. For the longest time, mutual funds in India actually benchmarked themselves against a price return index, or PRI. But that only captures the capital gains, literally just the price movement of the stocks in the index. But wait, what about the dividends? That is where the total return index, or TRI, steps in. TRI captures those capital gains plus all the dividends and interest payments generated by the index constituents. To put that in perspective, historical dividend yields in Indian markets typically ranged from 1.5% to 2.5%. So back when funds were using PRI, it actually gave them a slight, kind of unfair visual advantage because they were comparing their total returns against a benchmark that completely ignored dividends. To fix this and ensure a completely fair comparison, SEBI stepped in and mandated that mutual fund schemes must be benchmarked against the total return variant. All right, so we know we need a TRI benchmark, but how do we make absolutely sure we're comparing apples to apples? That brings us to part three, matching benchmarks to funds. Now, what's really interesting about this slide is that benchmarking gets a bit tricky with hybrid funds. The ones that invest in a mix of different assets. You obviously can't just use a pure equity index like the Nifty 50. Instead, you have to use a synthetic blended index. An aggressive hybrid fund, for example, might use a benchmark that is exactly 75% equity and 25% debt. A conservative hybrid fund flips that to 75% debt and 25% equity. To bring some much-needed uniformity to all of this, SEBI introduced a clever two-tiered structure. The Tier 1 benchmark reflects the broad category of the scheme. Think of a broad market index like the S&P BSE 100. It gives you the big picture view. Then, the Tier 2 benchmark is a lot more bespoke. It demonstrates the specific investment style or strategy of the fund manager. This dual approach essentially guarantees that you, the investor, can evaluate a fund both against the wider market and against its very specific niche. Okay, we've got our benchmarks sorted. Now let's explore part four, the math of risk. Because let's be real, earning a sky-high return means nothing if the manager took totally reckless risks to get you there. Think of risk like a speed limit. We absolutely have to factor it in. The very first crucial tool in our quantitative kit is the Sharpe ratio. This measures the risk premium generated per unit of risk. The formula is simply the scheme's return minus the risk-free return, which is usually calculated using a government T-bill index, all divided by the standard deviation. And standard deviation essentially measures the total volatility, or bumpiness of the fund. So a higher Sharpe ratio means the scheme generated better returns for the amount of overall risk it took on. Honestly, it's a fantastic indicator of efficiency. Next up is the Trainer ratio. Notice how similar the formula is here? It's the scheme's return minus the risk-free return, but this time it's divided by beta instead of standard deviation. Just like the Sharpe ratio, it calculates a risk premium per unit of risk, but it's actually measuring a very different kind of risk. So here is the absolute key distinction you need to remember as an evaluator. The Sharpe ratio uses standard deviation, capturing total volatility, which makes it universally useful for both debt and equity schemes. The Trainer ratio, on the other hand, uses beta, which strictly measures volatility relative to the broader market. Because beta is inherently tied to market movements, the Trainer ratio is really best restricted to diversified equity schemes. You want to make sure you're pulling the right tool for the job. Then we have alpha. If you've spent any time at All Around Investors, you've definitely heard this buzzword. Alpha is simply the difference between a scheme's actual return and its optimal return based on its beta. Basically, if the alpha is positive, it means the fund manager successfully outperformed the market expectations for that specific level of risk. And a negative alpha? Well, that just indicates underperformance. It really is the ultimate measure of the fund manager's active value add. Now, here's a metric that is so important, it's literally mandatory for asset management companies to disclose it daily, the information ratio. It calculates the portfolio return minus the benchmark return divided by the standard deviation of that excess return. What this does, in simple terms, is measure a portfolio manager's level of skill, and more importantly, their consistency in generating those excess risk-adjusted returns relative to their benchmark. Finally, for the math section, we have tracking error. This is the standard deviation of the excess returns generated by the fund relative to its benchmark. In the past, this was mostly just used for index funds to see how closely they mirrored the indexed, but today, it's heavily used for active funds too. It shows how tightly the fund's excess returns cluster around its target. A low tracking error doesn't mean wild, lucky swings. It actually means the manager's strategy is tightly controlled and deliberate. Let's move on and see how this builds in the real world. We've looked at all the abstract math, but where does the everyday investor actually find this data? That brings us to part 5, reading fund fact sheets, the paper trail for investors. Every single month, fund houses publish a fund fact sheet. It's the official paper trail of a fund's objective, its performance, and its portfolio. But honestly, it goes way beyond just the numbers we've discussed. Fund managers actually use fact sheets to communicate their views on the broader economy. These sheets provide critical macroeconomic metrics. They analyze how government fiscal deficits might push up market interest rates, how inflation impacts corporate profitability, and even how commodity prices, like oil, are affecting currency levels. It gives you a direct window into the manager's perspective on the overall economic climate. And hey, if you want an exhaustive resource to compare all of this data yourself, you head straight to the AMFI website. That's the Association of Mutual Funds in India. It is a vital central hub where you can systematically pull raw data, compare standard metrics, and track exactly how these funds perform across different time periods. It ensures you have all the transparent data you could ever need right at your fingertips. We've covered a ton of ground today, but I want to leave you with this incredibly powerful quote straight from our source material. While the calculations are arithmetic, they can be done by a novice. Scheme evaluation is an art, the job of an expert. The math we went through? It's really just a tool. Blind belief in Sharpe ratios or alpha without actually taking the time to understand the underlying macroeconomic factors and the fund manager's specific strategy, well, that's just dangerous. You now have the professional evaluator's toolkit. You know how to identify the right TRI benchmark, you understand the vital difference between total volatility and market volatility, and you know exactly where to find the fact sheets. But remember, calculations can be done by a novice, but evaluation, that is an art. So, the next time you look at a fund's performance, will you just glance at a standalone return, or will you actually look at the whole picture? Thanks for joining me on this explainer, and keep exploring.